Question 1. Scenario-based. Mr. Peterson is 55 years old and is planning for retirement. He has a moderate risk tolerance and would like to ensure a guaranteed income for life starting at age 65. He is considering purchasing a fixed annuity to help supplement his retirement income. The annuity he is considering includes a rider for inflation protection, ensuring his payments will increase to keep pace with inflation. However, the rider significantly increases the premium. What should Mr. Peterson do to ensure this annuity purchase aligns with his best interests? A. Purchase the annuity with the inflation rider because it will provide a higher income in the future. B. Purchase the annuity without the inflation rider to reduce the premium and invest the difference in other assets. C. Consider a variable annuity to provide greater growth potential without the inflation rider. D. Request a second opinion from another financial advisor to evaluate the impact of the rider on his long-term financial plan. Answer. D. Request a second opinion from another financial advisor to evaluate the impact of the rider on his long-term financial plan. Explanation. In this scenario, Mr. Peterson's best interest is to make a well-informed decision that aligns with his financial goals. While an inflation rider may provide peace of mind, it significantly increases the premium, which may not be the most cost-effective solution for his goals. Requesting a second opinion ensures that all aspects of the annuity, including the rider's cost and long-term benefits, are fully considered. This aligns with the suitability standard and the best interest standard for annuity recommendations in Arkansas. Option A is incorrect because assuming the inflation rider will automatically provide a higher future income may not consider the long-term impact of the premium increase. Option B might be tempting but doesn't consider the possibility that the annuity may be an appropriate tool for securing guaranteed retirement income. Option C ignores Mr. Peterson's preference for a guaranteed income and does not assess the suitability of variable annuities, which carry more risk than fixed annuities. Question 2. Conceptual understanding. Which of the following statements about tax-deferred growth in annuities is correct under Arkansas law? A. The interest earned on a non-qualified annuity is subject to income tax as soon as it is credited to the account. B. A qualified annuity, such as one purchased with funds from an IRA, will grow tax-deferred until withdrawals are made. C. Tax-deferred growth applies only to fixed annuities and does not apply to variable annuities. D. Withdrawals from an annuity during the accumulation phase are not subject to taxes under any circumstances. Answer. B. A qualified annuity, such as one purchased with funds from an IRA, will grow tax-deferred until withdrawals are made. Explanation. Under Arkansas and federal tax law, qualified annuities such as those purchased with funds from an IRA or 401k allow for tax-deferred growth. This means that the funds grow without being taxed until they are withdrawn, typically during retirement. This is a key benefit of annuities used for retirement planning. Option A is incorrect because interest on non-qualified annuities is taxed upon withdrawal, not when credited to the account. Option C is incorrect because both fixed and variable annuities benefit from tax-deferred growth. Option D is incorrect because any withdrawal from an annuity, whether in the accumulation phase or payout phase, is generally subject to taxation unless it is a return of principal. Question 3. Advanced conceptual. Which of the following is a key requirement under Arkansas regulations for the sale of annuities to ensure that the product is suitable for the buyer? A. The agent must ensure the annuity is the lowest cost option available on the market. B. The agent must conduct a thorough needs analysis and document the customer's financial goals, risk tolerance, and age. C. The agent must only offer fixed annuities to clients aged 60 and above. D. The agent must sell only those annuities that promise the highest return regardless of the client's risk tolerance. Answer. B. The agent must conduct a thorough needs analysis and document the customer's financial goals, risk tolerance, and age. Explanation. Arkansas regulations emphasize the importance of the suitability standard in annuity sales. This standard requires the agent to conduct a comprehensive needs analysis, which includes understanding the client's financial goals, risk tolerance, and age. This ensures the annuity recommended aligns with the client's personal circumstances and retirement objectives. Option A is incorrect because the lowest cost option may not always be the most suitable product for a client's needs. Option C is incorrect because age alone is not a determining factor for recommending an annuity type. The agent must base the recommendation on a comprehensive analysis. Option D is incorrect because a high return may not align with a client's risk tolerance and financial goals, and recommending such an annuity could be considered unsuitable or unethical. Question 4. conceptual understanding which of the following is a primary difference between a fixed annuity and a variable annuity under Arkansas law. A. Fixed annuities offer guaranteed returns, while variable annuities expose the principal to market risk. B. Fixed annuities are only available through employer-sponsored retirement plans, while variable annuities can be purchased individually. C. Variable annuities provide fixed monthly payouts, while fixed annuities provide payouts that vary based on the performance of underlying investments. D. Fixed annuities allow for unlimited premium payments, while variable annuities impose strict limits on contributions. Answer A. Fixed annuities offer guaranteed returns, while variable annuities expose the principal to market risk. Explanation: the key difference between a fixed annuity and a variable annuity lies in the investment structure. Fixed annuities provide guaranteed returns, meaning the insurance company agrees to pay a fixed interest rate on the premiums, regardless of market conditions. In contrast, variable annuities allow the premiums to be invested in sub-accounts linked to market performance, which exposes the principal to market risk. Option B is incorrect because both types of annuities can be purchased individually. Option C is incorrect because the payouts from variable annuities are not fixed. They vary based on the performance of underlying investments. Option D is incorrect because both types of annuities have premium limits and variable annuities often have a range of investment options, while fixed annuities do not. Question 5. Conceptual understanding which of the following is not a requirement under the Arkansas Insurance Code when selling annuities to a consumer? A. Providing a free look period for the consumer to cancel the annuity contract. B. Ensuring the annuity is the most expensive option to provide maximum commission for the agent. C. Offering clear disclosure documents that outline the features, costs, and benefits of the annuity. D. Verifying the suitability of the annuity by conducting a needs analysis based on the client's financial situation. Answer B. Ensuring the annuity is the most expensive option to provide maximum commission for the agent. Explanation: under the Arkansas Insurance Code and consumer protection laws, an annuity must be sold based on suitability and transparency to ensure that it meets the financial needs and goals of the buyer. Option B is incorrect because it violates ethical standards. Agents should not recommend products simply to maximize their commission. Instead, agents must focus on the client's best interest, not profit from the sale. Options A, C, and D are all required by law. A free look period allows consumers to review the contract and cancel if needed. Clear disclosure documents are required by both state regulations and federal rules to ensure transparency. Finally, conducting a needs analysis is necessary to assess the suitability of the annuity. Question 6. Advanced conceptual Mr. and Mrs. Robinson are considering purchasing a joint and survivor annuity. They are in their early 60s and want to ensure that both of them receive a steady income throughout their retirement, with payments continuing to the surviving spouse upon the death of one of them. Which of the following is the most important consideration when purchasing a joint and survivor annuity? A. The annuity should provide the highest initial payout, regardless of the survivor benefit. B. The annuity should include an inflation protection rider to ensure payments increase over time. C. The annuity should balance the needs of both spouses, considering their life expectancy and overall financial goals. D. The annuity should have a high surrender charge to minimize the risk of early withdrawal. Answer: C. The annuity should balance the needs of both spouses, considering their life expectancy and overall financial goals. Explanation: the most important factor when purchasing a joint and survivor annuity is ensuring that it meets the retirement income needs of both spouses, while also considering life expectancy and financial goals. A joint and survivor annuity is designed to provide income for both spouses, with the income continuing to the survivor after one spouse's death. Option C is the best choice because it considers both spouses' needs and long-term financial objectives. Option A is incorrect because focusing solely on the highest initial payout may not take into account the long-term sustainability of the income or the survivor benefit. Option B is also important but not the primary focus, as the rider could increase premiums significantly. Option D is incorrect because surrender charges should not be prioritized when considering income stability for retirement. Question 7. Regulatory knowledge under Arkansas law. Which of the following actions does not violate the suitability requirements for selling annuities? A. Recommending a fixed annuity to a 75-year-old client with a high-risk tolerance. B. Selling a variable annuity to a client who has a moderate risk tolerance and a 20-year retirement horizon. C. Encouraging a client to purchase an annuity with a high surrender charge to maximize agent commissions. D. Selling an annuity with a guaranteed minimum withdrawal benefit to a client with retirement income goals. Answer: B. Selling a variable annuity to a client who has a moderate risk tolerance and a 20-year retirement horizon. Explanation: when selling annuities under Arkansas law, suitability is a primary consideration. In this case, recommending a variable annuity to a client with moderate risk tolerance and a long retirement horizon, 20 years, is suitable because variable annuities are designed to provide growth potential over the long term, aligning with the client's investment risk tolerance and time horizon. Option A is incorrect because recommending a fixed annuity to a 75-year-old client with a high risk tolerance may not be appropriate, as fixed annuities offer more conservative returns. Option C is incorrect because encouraging clients to purchase an annuity based on commissions violates ethical and legal standards. Option D is also incorrect because while a guaranteed minimum withdrawal benefit rider may be beneficial, it may not be suitable for all clients depending on their needs, risk profile, and objectives. Question 8. Taxation of annuities. Which of the following is true regarding the tax treatment of annuities in Arkansas? A. The principal portion of a non-qualified annuity withdrawal is taxed as ordinary income. B. Interest earned on a qualified annuity is not taxable when it is credited to the account. C. Taxation of annuity death benefits is always excluded from income tax in Arkansas. D. The interest portion of a withdrawal from a non-qualified annuity is subject to income tax under the LIFO method. Answer: D. The interest portion of a withdrawal from a non-qualified annuity is subject to income tax under the LIFO method. Explanation: under Arkansas tax law, the interest portion of a withdrawal from a non-qualified annuity is taxed under the LIFO last-in, first-out method. This means that the most recent earnings interest are taxed first, which is the opposite of the FIFO first-in, first-out method used for other investments. Option A is incorrect because the principal portion is not taxed until the entire principal has been returned. Option B is incorrect because interest earned on qualified annuities is subject to tax upon withdrawal, not when credited. Option C is incorrect because annuity death benefits are subject to taxation unless the beneficiary is a spouse or falls within specific exceptions. Question 9. Annuity contract provisions. Which of the following provisions in an annuity contract allows a policyholder to withdraw a portion of their funds without incurring a penalty? A. The surrender charge provision. B. The free look period provision. C. The penalty-free withdrawal provision. D. The required minimum distribution (RMD) provision. Answer: C. The penalty-free withdrawal provision. Explanation: the penalty-free withdrawal provision allows the policyholder to withdraw a portion of their annuity funds without incurring a surrender charge or early withdrawal penalties. These withdrawals are typically allowed after a specific waiting period or age, such as 591 WO. Option A is incorrect because the surrender charge provision applies when the policyholder fully or partially surrenders the annuity within a certain period, typically resulting in a penalty. Option B refers to the free look period, which is a set time after purchasing an annuity during which the policyholder can cancel the contract, but it does not apply to withdrawals. Option D is incorrect because RMDs are typically required for tax-deferred accounts such as ERAs, but they are not a specific penalty-free withdrawal option within an annuity contract. Question 10. Annuity riders and options. Which of the following riders is most commonly added to a fixed annuity to help address concerns about future inflation? A. Guaranteed minimum income benefit (GMIB). B. Inflation protection rider. C. Long-term care rider. D. Guaranteed minimum withdrawal benefit. Answer: B. Inflation protection rider. Explanation: the inflation protection rider is designed to help ensure that the purchasing power of an annuity's payments keeps pace with inflation over time. This rider typically increases the annuity's payout each year based on a fixed percentage or an inflation index. This is particularly important for individuals who are concerned about how inflation might erode the value of their future annuity payments. Option A. The Guaranteed Minimum Income Benefit (GMIB) guarantees a certain income regardless of market performance, but does not address inflation directly. Option C. The Long-Term Care Rider provides benefits if the annuity holder needs long-term care services but is unrelated to inflation protection. Option D. The Guaranteed Minimum Withdrawal Benefit ensures that the annuity holder can withdraw a specified percentage of the initial premium each year, but it does not specifically protect against inflation. Question 11. Regulation and compliance under the Arkansas Annuity Suitability Regulations. What is the primary responsibility of an insurance agent when recommending an annuity to a consumer? They ensure that the annuity generates the highest commission for the agent. B. Ensure that the annuity is suitable for the consumer's financial situation, objectives, and risk tolerance. C. Recommend only fixed annuities to consumers over the age of 65. D. Guarantee that the consumer's principal will be preserved regardless of market conditions. Answer: B. Ensure that the annuity is suitable for the consumer's financial situation, objectives, and risk tolerance. Explanation: under Arkansas law, suitability is a critical requirement when recommending annuities. The agent must assess the consumer's financial situation, objectives, and risk tolerance to ensure that the annuity is an appropriate product. This includes considering factors such as the consumer's age, income needs, and investment experience. Option is incorrect because recommending products based solely on commission violates ethical standards and consumer protection laws. Option C is incorrect because agents are not restricted to recommending only fixed annuities for individuals over 65, or the suitability analysis is key. Option D is also incorrect because no annuity can guarantee principal preservation in all market conditions, especially variable annuities. Question 12. Annuity taxation in Arkansas. What is the tax treatment of the interest earned on a non-qualified annuity when withdrawn? A. It is taxed as ordinary income in the year of withdrawal. B. It is taxed as long-term capital gains. C. It is not taxed if withdrawn before age 591 WO. D. It is tax-free under Arkansas state law. Answer A. It is taxed as ordinary income in the year of withdrawal. Explanation: the interest earned on a non-qualified annuity is taxed as ordinary income when withdrawn. This means the earnings are taxed at the same rate as the consumer's regular income. The last in, first out LIFO method applies where the last portion of the annuity to be earned, the interest, is considered the first to be taxed. Option B is incorrect because non-qualified annuity earnings are taxed as ordinary income, not capital gains. Option C is incorrect because the taxation on the interest applies when the earnings are withdrawn regardless of age, although early withdrawals may incur penalties. Option D is incorrect because annuity earnings are subject to federal and state taxes. Question 13. Ethical considerations. Which of the following actions is considered unethical by the Arkansas Department of Insurance when selling annuities? A. Recommending an annuity that is suitable for the consumer's financial goals and risk tolerance. B. Failing to disclose all charges and fees associated with an annuity to the consumer. C. Offering a free consultation to explain annuity options in detail. D. Suggesting an annuity to a client based on a thorough needs analysis. Answer: B. Failing to disclose all charges and fees associated with an annuity to the consumer. Explanation: failure to disclose all charges and fees associated with an annuity is considered unethical and is a violation of both state and federal consumer protection laws. Insurance agents must fully inform consumers about the costs, fees, and charges associated with the annuity product to ensure transparency and allow consumers to make informed decisions. Option is ethical because it involves recommending a suitable product. Option C is acceptable as it represents providing useful information to the consumer. Option D is also ethical as long as it involves a thorough and accurate needs analysis to ensure the annuity is in the best interest of the client. Question 14. Annuity contract terms. Which of the following is a key feature of a deferred annuity in Arkansas? A. The annuity provides income payments immediately after the contract is purchased. B. The annuity's value is subject to market fluctuations from the time of purchase. C. The annuity allows the policyholder to postpone income payments until a later date. D. The annuity must be purchased with tax-free funds. Answer: C. The annuity allows the policyholder to postpone income payments until a later date. Explanation: a deferred annuity allows the policyholder to delay receiving income payments until a later date, which is usually at retirement. During the deferral period, the annuity grows on a tax-deferred basis. Option A describes an immediate annuity, not a deferred one. Option B describes a variable annuity, which is subject to market fluctuations. Option D is incorrect because deferred annuities can be purchased with either taxable or tax-deferred funds, such as from an IRA or other qualified retirement plan. Question 15. Annuity riders and options. Which of the following is true regarding the Guarantee Minimum Income Benefit (GMIB) rider in Arkansas? A. It guarantees a minimum level of income regardless of the annuity's investment performance. B. It allows the policyholder to access a lump sum of their annuity value at any time. C. It provides protection against inflation by adjusting the annuity payments yearly. D. It guarantees that the policyholder will receive the same payout regardless of life expectancy. Answer A. Guarantees a minimum level of income regardless of the annuity's investment performance. Explanation. The guaranteed minimum income benefit GMIB rider ensures that the annuity holder will receive a minimum income even if the underlying investments perform poorly. The rider does not guarantee a specific rate of return, but it protects against market downturns by assuring a baseline level of income. Option B is incorrect because the GMIB does not allow for lump sum access. It typically applies to income streams. Option C describes an inflation rider, not the GMIB. Option D is incorrect because the GMIB ensures a minimum income level, but it is not a guarantee of the same payout regardless of life expectancy. Question 16. Annuity types. Which type of annuity offers the highest level of risk and potential reward due to its direct exposure to market performance? A. Fixed annuity. B. Indexed annuity. C. Variable annuity. D. Immediate annuity. Answer. C. Variable annuity. Explanation. A variable annuity offers the highest level of risk and potential reward because its value is directly linked to the performance of underlying investments such as mutual funds. The policyholder's account value can fluctuate depending on market conditions, which presents both opportunities and risks. Fixed annuities provide guaranteed returns. Indexed annuities are tied to market indices but typically have capped returns, and immediate annuities start income payments immediately after purchase without market exposure. Question 17. Annuity surrender charges. What is the typical purpose of surrender charges in an annuity contract? A. To penalize early withdrawals and discourage early termination of the contract. B. To cover the insurance company's marketing expenses. C. To provide the policyholder with additional tax-free benefits. D. To compensate the policyholder for any losses in the annuity's value. Answer A. To penalize early withdrawals and discourage early termination of the contract. Explanation. Surrender charges are typically imposed when the policyholder withdraws funds from an annuity before the end of the surrender period. These charges discourage early withdrawals and are designed to recoup costs that the insurance company incurs in issuing the annuity. Option B is incorrect because surrender charges are not intended for marketing expenses. Option C is incorrect because surrender charges are not related to providing tax benefits. Option D is incorrect because surrender charges are a penalty, not a form of compensation for losses. Question 18. Annuity income payments. Which of the following best describes an annuitant's income payments in a fixed immediate annuity? A. Payments are based on the performance of the stock market. B. Payments begin immediately after the annuity is purchased and remain fixed for the annuitant's lifetime. C. Payments are variable and depend on the annuity's performance. D. Payments are guaranteed to increase each year based on inflation. Answer. B. Payments begin immediately after the annuity is purchased and remain fixed for the annuitant's lifetime. Explanation. A fixed immediate annuity starts providing income payments immediately after the contract is purchased, with the amount of the payment fixed and guaranteed for the duration of the annuitant's life or a specified term. Option A refers to variable annuities, where payments are tied to market performance. Option C describes variable annuities, and Option D refers to inflation protection riders, which are not inherent to all annuities. Question 19. Annuity taxation. Which of the following statements regarding annuity taxation in Arkansas is correct? A. Withdrawals from a non-qualified annuity are taxed as capital gains. B. The entire amount withdrawn from a qualified annuity is tax-free. C. Only the interest portion of withdrawals from a non-qualified annuity is taxable. D. Premiums paid into an annuity are tax-deductible. Answer. C. Only the interest portion of withdrawals from a non-qualified annuity is taxable. Explanation. In a non-qualified annuity, only the interest portion of withdrawals is subject to taxation. The principal portion, which was paid with after-tax dollars, is not taxed again. Option A is incorrect because non-qualified annuity earnings are taxed as ordinary income, not as capital gains. Option B is incorrect because qualified annuities are taxable when withdrawals are made. Option D is incorrect because premiums paid into an annuity are not tax deductible unless the annuity is held in a qualified retirement plan. Question 20. Suitability standards. What must an insurance agent do to comply with Arkansas suitability regulations when recommending an annuity? A. Ensure that the annuity will generate the highest commission for the agent. B. Recommend an annuity based on the consumer's current financial situation, needs, and objectives. C. Sell annuities only to consumers over the age of 65. D. Recommend variable annuities for all clients to maximize market potential. Answer: B. Recommend an annuity based on the consumer's current financial situation, needs, and objectives. Explanation: under Arkansas suitability regulations, insurance agents must base their annuity recommendations on the consumer's financial situation, needs, and objectives. This is to ensure that the annuity is a suitable product for the client. Option A is incorrect because the agent's commission should not be a factor in recommending products. Option C is incorrect because there is no age restriction for selling annuities. Option D is incorrect because the suitability analysis should be done individually for each consumer. Question 21. Annuity riders. Which of the following annuity riders would likely provide the most protection against long-term care needs? A. Guaranteed minimum income benefit GMIB. B. A long-term care rider. C. Inflation protection rider. D. Death benefit rider. Answer: B. Long-term care rider. Explanation: the long-term care rider is designed to provide benefits if the annuity holder needs long-term care services such as assistance with daily activities or a nursing home stay. It helps to address the financial risks associated with long-term care expenses. Option A is a rider for guaranteeing minimum income, not long-term care. Option C addresses inflation protection, not care needs. Option D refers to a death benefit rider, which provides benefits to beneficiaries upon the annuitant's death, not long-term care coverage. Question 22. Annuity surrender options. If a policyholder wants to surrender an annuity before the end of the surrender period, which of the following is most likely to happen? A. The policyholder may receive the full amount of the annuity's value. B. The insurance company will waive any surrender charges if the policyholder is under the age of 65. C. The policyholder may face surrender charges, reducing the amount received. D. The insurance company will refund all premiums paid into the annuity without penalty. Answer: C. The policyholder may face surrender charges, reducing the amount received. Explanation: surrender charges are typically assessed when an annuity is surrendered before the end of the surrender period, and they can significantly reduce the amount the policyholder receives. These charges are meant to discourage early withdrawals. Option A is incorrect because surrender charges are usually applied, so the policyholder does not receive the full value. Option B is incorrect because surrender charges apply regardless of age unless specified by the policy. Option D is incorrect because premiums are not refunded without penalties unless the policy has specific provisions for free withdrawals. Question 23. Regulation of annuities. Which of the following statements is true regarding the regulation of annuities in Arkansas? A. Only fixed annuities are regulated by the Arkansas Department of Insurance. B. Annuities must be sold in compliance with Arkansas suitability standards and disclosure requirements. C. The Arkansas Department of Insurance regulates annuities, but does not oversee their sales practices. D. Arkansas law requires that all annuities be offered to consumers free of charge. Answer: B. Annuities must be sold in compliance with Arkansas suitability standards and disclosure requirements. Explanation: annuities sold in Arkansas must comply with the suitability regulations, which ensure that the product is appropriate for the consumer's needs, goals, and financial situation. Additionally, the disclosure requirements mandate that consumers are fully informed about the terms and conditions of the annuity, including charges and fees. Option is incorrect because both fixed and variable annuities are regulated by the Arkansas Department of Insurance. Option C is incorrect because the department oversees both the regulation and sales practices of annuities. Option D is incorrect because annuities are not offered free of charge. Question 24. Annuity payout options. Which of the following payout options provides income for a specified period of time, regardless of whether the annuitant lives or dies? A. Life only option. B. Life with period certain option. C. Fixed period option. D. Joint and survivor option. Answer: C. Fixed period option. Explanation: the fixed period option provides income payments for a specified period, such as 10 or 20 years, regardless of whether the annuitant survives the entire period. If the annuitant dies before the period ends, the remaining payments are typically made to a beneficiary. Option A, the life-only option, provides income for the annuitant's lifetime but stops upon their death. Option B, life with period certain, provides income for life, but if the annuitant dies early, the payments continue to a beneficiary for the remainder of the specified period. Option D, joint and survivor, provides income for the lives of two people with payments continuing to the surviving spouse. Question 25. Annuity exchanges. What is the primary benefit of a 1035 exchange for annuities? A. It allows the policyholder to receive a lump sum payment from the annuity. B. It allows the policyholder to transfer an annuity to another insurance company without triggering a taxable event. C. It allows the policyholder to convert a fixed annuity into a variable annuity. D. It allows the policyholder to withdraw funds from the annuity tax-free. Answer: B. It allows the policyholder to transfer an annuity to another insurance company without triggering a taxable event. Explanation: a 1035 exchange allows policyholders to transfer the value of one annuity to another without incurring taxes as long as the transfer is direct and involves similar types of insurance products, e.g., annuity to annuity. This exchange provides an opportunity to switch to a different annuity product without triggering a taxable event, which could otherwise result in tax liabilities. Option A is incorrect because a lump sum payment is a type of withdrawal not related to 1035 exchanges. Option C is incorrect because conversions between annuity types are not the primary feature of a 1035 exchange. Option D is incorrect because withdrawals are typically taxable unless structured as part of a 1035 exchange. Question 26. Fixed indexed annuities. Which of the following is a key feature of a fixed indexed annuity? A. The value of the annuity is entirely based on market performance. B. The annuity provides fixed returns guaranteed by the insurer, regardless of market performance. C. The annuity's returns are linked to a specific market index, but the policyholder is not exposed to the risk of market losses. D. The annuity guarantees a high rate of return based on the stock market's performance. Answer: C. The annuity's returns are linked to a specific market index, but the policyholder is not exposed to the risk of market losses. Explanation: a fixed indexed annuity (FIA) provides returns based on the performance of a market index, such as the S&P 500, but with built-in protection against market losses. The annuity is structured to offer potential growth based on the index's performance, but the policyholder's principal is typically protected from market downturns. Option A is incorrect because market performance only influences the returns, not the annuity's value directly. Option B is incorrect because fixed returns apply to fixed annuities, not FIAs. Option D is incorrect because FIAs do not guarantee high returns based on the stock market. There are usually caps and participation rates that limit potential returns. Question 27. Annuity beneficiaries. What happens if the annuitant of a joint and survivor annuity passes away? A. The surviving spouse receives a lump sum payment of the annuity's current value. B. The surviving spouse continues to receive annuity payments, typically at a reduced amount. C. The annuity payments cease completely upon the annuitant's death. D. The surviving spouse receives the remaining principal of the annuity. Answer: B. The surviving spouse continues to receive annuity payments, typically at a reduced amount. Explanation: a joint and survivor annuity provides income for two individuals, often spouses, for their lifetimes. Upon the death of one spouse, the surviving spouse continues to receive payments, typically at a reduced amount, e.g., 50% or 75% of the original payment. Option A is incorrect because there is no lump sum payout, and the payments continue. Option C is incorrect because the payments do not cease, so they continue to the survivor. Option D is incorrect because the remaining principal is not paid out. Instead, annuity payments continue to the survivor. Question 28. Qualified annuities. Which of the following is a characteristic of a qualified annuity? A. Premiums are paid with after-tax dollars. B. Contributions to the annuity are tax deductible. C. The annuity's earnings are not subject to taxation. D. Withdrawals from the annuity are tax-free if made after age 591. Answer: B. Contributions to the annuity are tax-deductible. Explanation: a qualified annuity is typically held in a tax-deferred retirement account, such as an IRA or 401k. Contributions to qualified annuities are generally tax-deductible, meaning that they reduce the taxable income for the year in which they are made. Option is incorrect because premiums for qualified annuities are typically paid with pre-tax dollars. Option C is incorrect because the earnings of a qualified annuity are tax-deferred, not tax-free. Option D is incorrect because withdrawals from qualified annuities are taxable as income regardless of age. Question 29. Annuity payment structures. Which of the following best describes the life with period certain payout option for annuities? A. The annuitant receives payments for life, but if they die early, payments continue to a beneficiary for a specified number of years. B. Payments are made to the annuitant for a specified number of years and no further payments are made after that period ends. C. The annuitant receives payments for life and the payments end upon death. D. Payments continue for a fixed period of time regardless of the annuitant's life expectancy. Answer A. The annuitant receives payments for life, but if they die early, payments continue to a beneficiary for a specified number of years. Explanation: the life with period certain option guarantees the annuitant income for life. If the annuitant passes away before the period certain ends, the payments continue to a beneficiary for the remainder of that period. Option B is incorrect because it describes the fixed period option, not a life option. Option C is incorrect because the life-only option stops payments upon the annuitant's death. Option D is incorrect because it describes a fixed period payout, not a life with period certain structure. Question 30. Annuity riders. Which of the following is the primary purpose of the death benefit rider on an annuity? A. To provide the annuitant with a higher income during their lifetime. B. To guarantee the policyholder's beneficiaries receive a specified amount upon the annuitant's death. C. To allow the annuitant to access funds in case of long-term care needs. D. To protect the annuity from market fluctuations. Answer B. To guarantee the policyholder's beneficiaries receive a specified amount upon the annuitant's death. Explanation: a death benefit rider guarantees that if the annuitant passes away during the accumulation phase, the beneficiary will receive a specified amount, often the contract value or the premium paid, whichever is higher. Option is incorrect because the death benefit rider does not increase income for the annuitant. Option C is incorrect because this describes a long-term care rider, not a death benefit. Option D is incorrect because the death benefit rider does not protect against market fluctuations.